Inflation is the term used to describe the rate at which prices of goods and services increase across the economy. It is influenced by the amount of money relative to the supply of available goods, supply shocks, and inflation expectations. Inflation can be measured by different indexes that track the changes in prices paid by consumers and producers. A small amount of inflation can be beneficial to economic growth, but high inflation can harm consumers and dampen economic activity. Inflation affects the economy and the common people in various ways. Some of the common effects of inflation are: it reduces the purchasing power of money. This means that people can buy less with the same amount of money as before. For example, if a cup of coffee cost 25 cents in 1970 and $1.59 in 2019, then $5 could buy 20 cups of coffee in 1970 but only 3 cups in, it increases the cost of living. This means that people have to spend more on basic necessities such as food, utilities, and gasoline. For example, pasta prices rose at a rate of 60% in the UK in the year to September. It increases the cost of doing business. This means that companies have to pay more for inputs used in production, such as raw materials, intermediate products, and finished machinery. This can reduce their profits and competitiveness. It affects borrowing and lending. This means that interest rates tend to rise with inflation, making it more expensive to borrow money and more attractive to save money. This can affect mortgages, loans, bonds, and other forms of debt and investment. It affects income distribution. This means that inflation can benefit some groups and hurt others, depending on their sources and uses of income. For example, borrowers can benefit from inflation if their incomes rise faster than their debt payments, while lenders can lose from inflation if their interest income falls behind the rising prices. Similarly, workers can benefit from inflation if their wages increase faster than the prices, while savers can lose from inflation if their savings lose value over time. These are some of the ways that inflation can affect the economy and the common people. Inflation is not always bad or good, but it depends on its causes, magnitude, duration, and expectations. A stable and moderate inflation rate is generally considered desirable for a healthy economy. Inflation is a rise in the general level of prices of goods and services in an economy over a period of time. Inflation reduces the purchasing power of money and erodes the value of savings. Inflation can have various causes, such as excess demand, supply shocks, or expansionary monetary policy. In this section, we will discuss the main causes of inflation in India and how the Reserve Bank of India, RBI, monitors and measures it. One of the major causes of inflation in India is the increase in money supply. When the RBI prints more money or lowers interest rates, it increases the amount of money available in the economy. This can boost economic activity and growth, but it can also create excess demand for goods and services, which pushes up their prices. According to some estimates, the rate of increase in money supply in India has varied between 15 and 18% over the last few years, whereas the national output has increased at an annual average rate of only 4%. Another cause of inflation in India is deficit financing. This refers to the practice of borrowing money to finance government spending that exceeds its revenue. When the government borrows more money, it increases the public debt and adds to the money supply. This can also lead to higher inflation if the government spending is not matched by an increase in output or productivity. Deficit financing can also raise interest rates and crowd out private investment, which can hamper economic growth. A third cause of inflation in India is the increase in government expenditure. The government spends money on various schemes and programs for social welfare, infrastructure development, defense, subsidies, etc. These expenditures can stimulate economic activity and create employment, but they can also increase the aggregate demand for goods and services, which can raise their prices. Moreover, some of these expenditures are financed by printing money or borrowing from abroad, which can add to the inflationary pressure. A fourth cause of inflation in India is the inadequate agricultural and industrial growth. Agriculture is a key sector of the Indian economy, as it provides food and raw materials for other sectors and employs a large share of the population. However, agriculture is prone to supply shocks due to factors such as weather conditions, pests, diseases, etc. These shocks can reduce the output and availability of agricultural products, which can drive up their prices. Similarly, industrial growth is essential for increasing the production and supply of goods and services in the economy. However, industrial growth in India has been hampered by various constraints such as infrastructure bottlenecks, labor regulations, environmental issues, etc. These constraints can limit the capacity and efficiency of industries, which can result in higher costs and prices. A fifth cause of inflation in India is the rise in administered prices. These are prices that are fixed or controlled by the government or its agencies for certain goods and services such as electricity, water, fuel, etc. These prices are often set below their market levels to provide subsidies or benefits to certain sections of society or to achieve certain policy objectives. However, these prices can also distort the market signals and create inefficiencies and shortages. Moreover, when these prices are revised upwards to reflect their true costs or market conditions, they can cause a sudden spike in inflation. A sixth cause of inflation in India is the rising import prices. India imports various goods and services from other countries such as oil, gold, machinery, etc. These imports are essential for meeting the domestic demand and supporting economic activity. However, these imports also depend on factors such as exchange rates, global demand and supply conditions, tariffs, etc. These factors can affect the prices of imported goods and services, which can influence the domestic inflation rate. For instance, when the rupee depreciates against other currencies or when there is a global surge in oil prices, it makes imports more expensive for India, which can raise the cost of production and consumption. The RBI monitors and measures inflation using various indicators such as Wholesale Price Index, WPI, and Consumer Price Index, CPI. WPI measures the changes in prices of a basket of wholesale goods that are traded between businesses such as raw materials, intermediate goods, etc. CPI measures the changes in prices of a basket of retail goods and services that are purchased by urban consumers such as food, clothing, housing, etc. The RBI uses CPI as its main indicator for setting its monetary policy objectives and targets. The RBI aims to keep CPI inflation at 4% with a tolerance band of plus or minus 2% over the medium term. This means that the RBI tries to ensure that CPI inflation does not deviate too much from 4% over a period of time. The RBI controls inflation by employing a variety of monetary policy tools such as repo rate, reverse repo rate, bank rate, open market operations, statutory liquidity ratio, SLR, cash reserve ratio, CRR, liquidity adjustment facility, LAF, and market stabilization scheme, MSS. Repo rate is the rate at which the RBI lends money to commercial banks for short-term purposes. Reverse repo rate is the rate at which the RBI borrows money from commercial banks for short-term purposes. Bank rate is the rate at which the RBI lends money to commercial banks for long-term purposes. Open market operations are transactions where the RBI buys or sells government securities in the open market to influence the money supply and interest rates in the economy. SLR is the ratio of liquid assets that commercial banks have to maintain as a percentage of their total deposits. CRR is the ratio of cash reserves that commercial banks have to keep with the RBI as a percentage of their total deposits. LAF is a facility whereby the RBI provides liquidity support to commercial banks through repo and reverse repo operations. MSS is a scheme whereby the RBI issues treasury bills and bonds to absorb excess liquidity from the market. By using these tools, the RBI can increase or decrease the availability and cost of money in the economy, which affects the demand and supply of goods and services, and ultimately the inflation rate. For example, when the RBI wants to reduce inflation, it can raise the repo rate, reverse repo rate, bank rate, SLR, and CRR, and sell government securities in the open market. This will reduce the money supply and increase the interest rates in the economy, which will discourage borrowing and spending by consumers and businesses, and lower the aggregate demand for goods and services. This will ease the upward pressure on prices and bring down the inflation rate. Conversely, when the RBI wants to stimulate growth, it can lower the repo rate, reverse repo rate, bank rate, SLR, and CRR, and buy government securities in the open market. This will increase the money supply and decrease the interest rates in the economy, which will encourage borrowing and spending by consumers and businesses, and raise the aggregate demand for goods and services. This will boost the economic activity and output, but it may also increase the inflation rate. Thus, the RBI has to balance its dual mandate of maintaining price stability and supporting economic growth by using its monetary policy tools judiciously. This concludes our section on what are the main causes of inflation in India and how does the RBI monitor and measure it. Inflation is a persistent rise in the general level of prices of goods and services. It reduces the purchasing power of money and erodes the value of savings. Inflation can have negative impacts on the economy, such as discouraging investment, creating uncertainty, and reducing economic growth. Therefore, controlling inflation is an important policy objective for governments and central banks. There are different ways to control inflation, depending on the causes and the severity of the problem. Some of the common methods are: tightening monetary policy. This involves raising interest rates, reducing money supply, or selling government bonds to reduce the amount of money available for spending and borrowing. This can lower aggregate demand and reduce inflationary pressures. Implementing fiscal policy. This involves reducing government spending, increasing taxes, or running budget surpluses to reduce the fiscal deficit and public debt. This can also lower aggregate demand and reduce inflationary pressures. Applying supply-side policies. These are policies that aim to increase the productive capacity and efficiency of the economy, such as improving infrastructure, promoting innovation, enhancing competition, reducing regulations, and reforming labor markets. These can increase aggregate supply and reduce inflationary pressures. Managing exchange rates. This involves maintaining a stable or appreciating exchange rate to reduce the cost of imported goods and services, which can lower inflation. This can be done by intervening in the foreign exchange market or by pegging the domestic currency to another currency. However, these methods may not always be effective or sufficient to control inflation. They may also have some drawbacks or limitations, such as: tightening monetary policy may cause a slowdown in economic growth, higher unemployment, lower investment, and reduced consumer confidence. Implementing fiscal policy may face political constraints, time lags, crowding out effects, or adverse impacts on income distribution. Applying supply-side policies may take a long time to show results, require large investments, face institutional barriers, or create environmental problems. Managing exchange rates may expose the economy to external shocks, limit monetary policy autonomy, or create trade imbalances. Therefore, some alternative or complementary measures to control inflation may be needed. Some of these are: increasing agricultural production. This involves increasing the output and productivity of the agricultural sector, which can provide more food and raw materials for the economy and lower their prices. This can be done by implementing land reforms, interplanting different crops, using manure and fertilizers, adopting improved seeds and irrigation systems, practicing sustainable agriculture, and creating raised beds. Improving supply chains. This involves enhancing the efficiency and reliability of the distribution and transportation of goods and services from producers to consumers. This can reduce the costs of production and delivery, minimize wastage and spoilage, and ensure adequate supply. This can be done by investing in infrastructure, adopting digital technologies, strengthening logistics networks, diversifying suppliers, and building resilience. Reducing price controls. This involves removing or relaxing government-imposed limits on the prices of certain goods and services that may cause distortions in the market. Price controls may create shortages or surpluses, discourage production or consumption, encourage black markets or hoarding, or reduce quality or variety. Removing price controls may allow prices to reflect supply and demand conditions more accurately and reduce inflation. Implementing a windfall profits tax. This involves imposing a tax on excess profits earned by some corporations that charge high prices for their products or services due to market power or favorable conditions. A windfall profits tax may discourage price gouging or profiteering, redistribute income more fairly, and generate revenue for public spending or debt reduction. These alternative or complementary measures to control inflation may have some advantages or disadvantages depending on their design and implementation. They may also interact with other policies in complex ways. Therefore, they should be carefully evaluated and applied in accordance with the specific circumstances and objectives of each country.